Welcome back to IMF World Bank Week at the Atlantic Council. I'm Josh Lipsky, Senior Director of the Atlantic Council's GeoEconomics Center. We are live here inside the IMF at the HQ1 atrium for what is now our 10th edition of Decoding the World Economic Outlook, one of the events I look forward to the most, and I am so pleased to be joined again by Hung Tran, Nicole Goldin, Martin Mühleisen, Senior Fellows at the Atlantic Council, all with extensive experience at the IMF and World Bank. Our goal over the next 30 minutes is take you inside the IMF's flagship publication, the World Economic Outlook, and explain the language they used, what's in it, why it's in it, and also what's not in it, and what it means for policymakers around the world. These are some of the most important economic projections that come out from any international financial institution. We're going to dig into all of it here. Let's just start with the top lines that came out this morning. Global GDP growth, 3.2% in 2024, 3.2% in 2025, staying steady. The advanced economies at 1.8%, an upgrade to the US at 2.8%, superseding expectations from a year ago and certainly from 2 years ago when many predicted recession here in the US. But the euro area weaker, 0.8%, Germany 0.0, complete stagnation in the German economy. We'll talk about that. China with a small downgrade, 4.8% in the WEO. Emerging Asia overall remains strong. So the picture is mixed. Certainly good news on inflation that we'll dig into. Very difficult news on public debt. But the bottom line is a global economy that is growing a little better than people might have expected a year ago. Martin, what was your take reading the WEO this morning?
Yeah, I think it's a good take of where we are right now. It was also easier to write than a couple of the last editions, because that's when big shocks happened just a few weeks before the WEO was put out, and the team had to scramble to incorporate it. Now, the big event is in 2 weeks after the WEO has been issued, and we're
Presents
talking,
a different kind of challenge in
about
writing.
the US elections, yes. So the growth numbers are what they are. They are in a way tentative, because I think the election outcome, no matter who wins, will trigger some geopolitical events in either direction that could be both good or bad. So I would expect that in terms of geopolitics, there's going to be some volatility that we can't really assess at the moment. And again, it could be both good or bad. Also, I mean, what I think is remarkable is that both the GFSR and the WEO talk about the balance of risks being to the downside.
Yeah, that jumped out.
Now, that is in a way built into the construction of the WEO, because you could ask, well, if you know that the balance of risks is to the downside, why don't you just lower your expected growth to begin with,
Take us inside that a little. You've been on the other side of this from the IMF and the WEO drafting process. Why don't they do that?
Well, it has to do with the fact that the WEO is a bottom-up exercise. It starts with projections by the country teams that then get aggregated. There's some back and forth with the research department that looks at global aggregates. But generally, the country desks are a bit hesitant to tell their counterparts in the capitals that they're not doing as well as those counterparts think. And therefore, it gets all put into the risk direction in discussion. Now, in this case, I think the WEO is clear that medium-term growth looks lower than anything we had in the past on average. And I would think that the characterization of all these downside risks, whether it's trade, geopolitics, inflation surprises, just add to the fact that we're probably going to see a somewhat lower trajectory on average over the next couple of years.
Yeah, and that was something Kristalina was flagging, and the curtain raiser just seems to be a theme in the meeting. So might be a small victory right now on inflation, but there are serious structural issues to address in the years to come. Nicole.
Yeah, and just to pick up on that, I think, one thing that hit me was that 5-year projection. It was weak in April, it was weak last year, and it's still staying relatively weak. But to that point, yes, there's some success on the inflation front, but while global growth is staying relatively stable, we are seeing downside in the emerging market and developing economies. Even emerging Asia, which has been strong, is set to slow looking into 2025 and into next year. Sub-Saharan Africa, similar story. Emerging Europe, well, I'm sure we'll hear more about Europe in general, but emerging Europe, projected to go down. I think a number of the downside risks that Martin mentioned that we're thinking about, in particular if you look at conflict, obviously that affects the Middle East, North Africa particularly strongly, emerging Europe if you're looking at Russia's war in Ukraine, and a number of the other conflict and geopolitical tendencies have arguably a somewhat disproportionate impact on a lot of the emerging market and developing economies, and where there have been wins to some degree on inflation, as Martin just talked about, we are seeing, as we talked a little bit about yesterday, a slower and not as robust fall in inflation in many of the emerging market and developing economies, in particular some of the lower income countries. You have that divergence within the EMDEs around inflation. And lastly, you have the debt issue, which again impacts significantly many, if not most, of the EMDEs, and that is, I think, contributing to the low productivity, high inflation, low growth, and debt burdens that are keeping those projections relatively low.
On the public debt issue, I feel like a message already I'm hearing at these meetings is this time we're serious.
Yes.
We always talk about public debt, but this time we are telling you it's a real problem, 100% of global GDP, it's just coming through clearly. But Hung, I want to turn to you because I take what Martin's saying, I take what Nicole's saying, but the WEO and the presser today and the WEO blog does have a positive tone. First sentence, let's start with the good news. It looks like the global battle against inflation has largely been won. And then they say it's a major achievement to achieve this relative soft landing compared to where we've come. Are we not giving the global economy enough credit?
Right. 2 points I want to make. The first one is what you just asked me. Indeed, if you look back last year in Marrakesh, we were worried if we may be able to avoid a recession altogether, given the tightening mode of the Fed and other major central banks. At the end, the central banks managed to do it, produce a soft landing. Looking back, it wasn't at all clear that we could have done it. So I think it's quite all right to give credit where it's due, and I think the WEO properly did that. However, they failed to mention one important point, is that inflation may be lower because of lower activity and so on and so forth, and fiscal tightening, but the structural component of inflation is persistently high. They did point out that inflation for services are sticking at around 4%, whereas inflation for goods is down to 0. So the stickiness of services inflation is something that we need to keep an eye on. But more importantly, the whole geopolitical development, geo-economic fragmentation, trade, friction, tariffs, and so on and so forth, all of that point to higher cost of producing things, higher cost of doing business, particularly transnationally. So that always put upward pressure on cost. Cost push inflation. Not necessarily demand pull, but cost push for sure. So we are operating now going forward with a higher inflation expectation base compared with the years after the great financial crisis. And I think the WEO did not really tease out all the implication of that. So that's one key concern for me. Another key concern after my colleagues talk about the aggregate numbers is what's behind it. And what's behind it is the sharp division between some countries that have done well, US, one case, many Asian countries, India and so on, and the countries that have not done well. We talk about Europe, but low-income countries is really a concern. They suffer downgrade in growth, they have high debt, many of them have to spend 15% of their budget for interest service, which really crowd out all the necessity that they will have to spend money on. So I think that going forward, this division into the two camps, with the low-income country falling even further behind in catching up, will be a big problem socially, politically, and so on for the world economy.
Well, the downside risk you raised and was raised in the WEO blog that contributes to every economy in the world, including emerging markets and developing economies, is trade and trade frictions. Right. I mean, this is something that obviously in 2017, 2018 we were talking about and had not been talking about as much now, but it seems to be this looming fear in the background of the WEO, to your point, Martin, of this is the world as it is, but we understand it could look different. But how do they assess that in the forecast? Or is it just all, as you said, get put into the downside risk category?
Well, I mean, the implications for trade of all the geopolitical friction that we had hasn't been really so bad if you look at the numbers, right?
Yeah.
So there's been, maybe less direct imports from China to the US and so forth, but it's all gone through other countries, right? We have these connector countries now, as they say, so that, for example, China exports things to Mexico, and there they get then repackaged and sent to
Mexico
the
had a
US.
big downward revision, I saw.
Yes, I think that has to do with the new government. But so the actual degree of trade fragmentation isn't actually that bad. I mean, there's papers by the IMF, other think tanks had some events on that too. Yeah. And when you look at all that, it's actually surprising how much it has held up so far. I think the real concern that comes through at the moment also for emerging markets and developing countries has to do with the debt cost. And that has to do with bond yields more generally. The GFSR is very concerned about the situation in bond markets. So they think we have a relatively unique development right now in the yield curve. Short-term rates are coming down because central banks have been easing, but long-term yields haven't really moved that much. Yeah. And that's because of the fiscal position of the US and many other countries in the advanced world. Now, what does that mean for emerging markets? Well, they are not as attractive unless they also have to pay these high yields, right? The weaker dollar has helped them. So in terms of fighting inflation, I think the EMs have benefited also from the easing in the US and Europe. But they're still kind of facing relatively high debt costs. And the frontier markets, the low-income countries, of course, that remains a problem. So in a way, the real message, I think, this time is the GFSR. Things are fragile. Depending on what happens in the next couple of months, we could see a resurgence of stress in equity markets where valuations are very high. And bond yields are also jittery because of the debt evolvement, right? And I mean, the programs of both candidates in the US elections imply some increase in the fiscal deficit going forward. So that's clearly a concern.
It's just interesting what you say about the dollar, because of course you think the Fed cutting, this is good for countries around the world who have been under this pressure, but it's not so simple because of the yields, and it hasn't solved the issues in the way that you might think just from an interest rate cut.
Yes, emerging markets were the first to raise rates, right?
That's
but
right.
They still had trouble kind of getting inflation down because of the strong dollar. Yeah. Now that's kind of easing, but they still have to face high interest costs relative to advanced economies because there the yields just don't come down that fast.
So Nicole, on the what to do about it side, this is the kind of interesting framing in this WEO blog, the triple pivot. The former speechwriter in me has some quibbles because I think if you pivot 3 times you make a circle, but that's really a semantic issue. But of course, fiscal, monetary, structural, we understand how these issues are approached. Right. But what is really actionable from the policy side here at the WEO?
It's a good point. I mean, I think, maybe a pivot on 3 fronts is what they were trying to aim for, but I'm with you. I was like, am I reading this in a circular fashion? And maybe starting with the trade point. I think the trade often is discussed in concert with industrial policies, right? More protectionist policies. And one thing that caught my eye is a note about that while they may work in the short term to have some impact, in the longer term, they could bring a retaliatory effect and not necessarily have the effect desired. And one of the subtle aspects of the pivot is to think more about what we like to call at the Atlantic Council positive economic statecraft. So thinking how you bring in and balance what might be more punitive sort of policies, trade protectionism, tariffs, with other and kinds of more inducement-oriented kinds of tools, and whether that's the development financing on the domestic side, though domestic resource mobilization, and utilizing other kinds of economic policies and measures to sort of bring about the policy reforms that are needed and bringing in that support. I thought one of the other interesting pieces of the what to do about it gets into the chapter 3, one of the analytical chapters, where it talks about trust, because you can make recommendations for structural and structural reforms, and that inevitably there are going to be winners and losers, right? Inevitably, ultimately, often the poorest, those that are most vulnerable, are going to be on the outside of what those reforms mean. And so we talked a little bit about this yesterday as well. And so there's a case to be made for investing in bringing in trust, investing in communications and engagement, and thinking through who is going to be impacted by the policy reforms before they're inundated, and thinking about what are some of those supports to make sure that the negative impacts are minimized to the extent that they can be. So,
but on the structural reforms point, and Nicole, to you, and then to you, Hung, Kristalina has talked about this, the IMF has papers about this now, basically recognizing that in this era, there is bipartisan, and I don't mean that in a US perspective, I just mean in a kind of global political perspective, liberal and conservative parties, interest in fiscal spending and interest in not doing some of the structural reforms that we were taking about. So the policy advice is clear, but it's still the gap between there and action seems further than it's ever been.
It's tough. I mean, and part of it comes back to the fiscal environment and the fiscal constraints, right? These, especially in the debt constrained, the debt distress, or even liquidity constrained countries, they are having to make this trade-off between debt service and making the development investments or the supportive investments that can mitigate potentially some of the other more difficult reforms. And so that's where the rubber is somewhat meeting the road. I thought, to that point, I thought one of the other interesting things that did kind of come out strongly, something I and others of us have been talking about for some time, is the recognition of the demographic pressures.
Yes.
And how that factors into, again, not only who wins and who loses, but what some of the policies and the reforms should be, whether it's aging countries, in Asia or in Europe, or the younger countries in sub-Saharan Africa. We talked a little bit about, just the youth employment issue a bit yesterday. So I think, seeing the demographic kind of coming in against this other tide of constraints, geopolitical, trade, fiscal pressures, it's a challenge.
So Hung, I'll turn to you on that reform question, but I also want to ask you about China. I mean, probably the number I most closely watch, one, what is the US revision going to be 2 weeks ahead of the election? Obviously important. And what is the revision going to be to China? Taking into account the timing issues, we understand everything that's been announced in the past 2 weeks, stimulus can't be factored in here. But how did you read the China analysis specifically in the WEO?
Right. Let me go first with the fiscal consolidation effort, which is correctly pointed out by the WEO that countries need to do it because the government debt level is too high everywhere. However, one positive thing that they should have highlighted more and we should pay more attention is that in the past few years, countries by and large have been following a tighter fiscal policy stance than people thought they could have done at the beginning of the period. So compared with before, the expectation a year ago was that the fiscal stand will be a bit looser, plus 1 percentage point of GDP. It turned out, they look back in the past year, it's minus 1 percentage point. So every country, including the US, somehow tightened a little bit at the margin.
That's an important point, I think it gets overlooked.
Which is, in my view, is more easily feasible if you just do it at the margin. So the pain is not that widespread. So that is something we should keep in mind. On the structural reform thing, this time the WEO did go into something which I think is the right place, and that is you not only have to improve communication to explain the reform, but you really have to have a clear plan to compensate the potential loser of your reform. And I think that the fund next time should really delve deeper into it to look at and analyze why previous trade adjustment policy, trade adjustment facilities in the US, in the EU have failed to do that. Because economists recognize that a long time ago. You do trade, you do reform, you open up, winners, fine, a lot of losers. You have to do something to the loser. But all the program in the past 50 years clearly failed. So I think that is a rich area for the IMF team to look into, analyze, and come up with new proposals. So those are the key themes that we look at. The triple pivot that you talk about, do it 3 different things. I think that, again, that we all correctly point out that the political will and the political appetite to do that simply not there. So to go from here to here is very difficult, and it is really beyond the scope of WEO World Economic Outlooks to talk about political wills in country members.
Well, I mean, on that one,
please,
if you don't mind, the one chapter, the one chapter that they should have written, but of course it's not really the place for the WEO. But for an institution that really looks at global risks and global stability, the one chapter they should have written is about the threat by populism and the factors that are
Which
driving it.
they've talked about before, but haven't this time.
Yeah. There's a fantastic paper by several economists from the Kiel School of Economics in Germany and the American Economic Review some issue ago about the economic consequences of populism. It's pretty devastating.
Yeah.
Now, they don't go into the origins, but we have kind of at least two major trends colliding right now. One is the income concentration and the phase of technological change, which is somehow connected, right? Where a lot of people feel they're losing something, or they might lose something if things go in a direction where they lose their jobs because they're going to be rationalized out of a job or automated or whatever. Or of course, foreigners will take the job. And the other one is that in the advanced economies there's aging, demographic change, and you still have this bulge of young people coming out of emerging, well, mostly developing countries that desperately look for a way of making a living, and guess where they're going?
Yeah.
That's where there's implicit demand. Yeah. And even if people in the advanced economies say that they don't want any foreigners to come, they're very glad to have them if they're in a care facility or other place.
Fair point. Yeah.
So the fears that are being stoked about this migration, about the economic anxiety, make it just very difficult to do structural reforms or fiscal consolidation. And there's no way you can compensate losers. You cannot compensate for the perception of losing your job down the road. No handout from the government will make you change that. Yeah. In a way, the only thing you can do is reform in time. The Germans right now realize it. They're at the receiving end of a big major shock right now.
But arguably very late to the game.
Yes, and here in the US, it's of course perpetually continuing. I think the US will be in a better shape, has been in a better shape, like some of the countries in Europe, like Germany, that haven't really reformed. So, I mean, it's a very difficult kind of context right now, and that's what the IMF should at some point write about.
Nicole, and there's an AI component to all of this.
But just to pick up on that, I think, we've been talking about this, and, in the past we look at what's not in the WEO.
Yes.
And in the past, I will often chime in and say, we're not talking about inequality. But in the spring, we talked a little bit about inequality. Right. And here, to Martin's point, there was, in this chapter about, in this conversation about trust, this idea that the sort of or the perception of fairness and the distribution of fairness, right? And that, to me, is in some ways code for inequality, both within and across countries. And it's often, especially with young people, but I think all people react to their immediate circumstance. And they and policymakers make those, often decisions too on the short term, right? This is not just the US election year, but half the world's population. Went to the ballot box this year. And they're still making decisions on political decisions on short term, and people are making their decisions based on their perceptions and what that means and what that looks like. So, it's been interesting to see this recognition of what, again, the impact and that inequality and what that means to the difficulty. But it also points to, the need for, and maybe putting on my World Bank hat, but thinking about social safety nets, right? When you talk about, it's very hard to do, and it is, but there are policies, there are things that can be done to support people that may come out on the short end of the stick when it comes to the necessary structural reforms. And then, we talked a little bit about the sort of domestic resource mobilization side, and that's I think another piece of the puzzle that we can talk a little bit more about.
So, Hung, I want to come to you and dig into China a little bit, because
and then we'll come back to AI.
And then we'll come back to AI, China and AI in the time we have left. But I think there's real question marks, and Martin, you'll talk to Brad Setzer tomorrow about Chinese data, IMF inputs, forecasting related to China, imbalances. When we see 4.8% here, do you think that's accurate? Understanding just from where it was, snapshot 2 months ago, does the IMF have a good picture of what's happening inside China's economy?
Well, I look at it from this way. In the tradable section of any economy, since they trade with other countries, the data of production, goods, service coming out of tradable sections tend to be more reliable because China report export,
two-way street on
the other
trade,
country
yeah.
report import, so
Sure.
it check out. So and since trade represent a big chunk of any economy, you are starting off with a solid base of pretty good data, number one. Number two, with IMF, World Bank, and UN Statistical Office, all look at how to harmonize, how to get country to adopt same methodology in terms of calculating, sampling, and so on and so forth. By and large, countries are moving toward kind of comparable approach in collecting data. And if you really nitpick, then you can nitpick any country, even this country, the way they compile data. So at the end of the day, I look at data as more give you a sense of a trend line, because if they cheat and they are consistent and cheat the same way over time, the trend line will tell you the story.
That makes
You
sense.
you just set it upward or downward, but the trend line show you the same story.
Okay, that's a useful way to
So
think about it.
basically, if you apply that to China, it is clear that they had grown very significantly until 10 years ago, and they slowed down visibly in the past 10 years. That is their numbers. And I think those numbers are very, I mean, for what it's worth, usable, because simply just looking at satellite picture of lighting and smoke rising from factory, those are really snapshots that cannot be really used as a internally consistent body of statistics that you can really analyze. So my approach is that take the numbers that you use and then try to look at the trend rather than the level.
Okay, point taken, but Martin, let me just follow up on that and ask, if China was actually growing at 4.8% or close to 5%, would we have seen the weekend stimulus announcements without, again, we didn't get specifics on it, but will we see the policy response we seem to be seeing from the PBOC and the finance ministry if it was really growing at close to 5%, which is the benchmark goal?
Well, it's very difficult for me to say. I mean, the question is how effective these policies are going to be. So just the fact that the Chinese stock market rocketed up and then corrected again,
that's a good point.
shows that there's some volatility here. People want to believe it. They see China as an investment opportunity, but then they also have doubts and take their money back out very quickly. So I do think one has to be a bit careful looking at Chinese data, and that's not necessarily ill will. But it's also a capacity issue. Surprisingly, in some respects, Chinese officials are very good, but they're still having sometimes problems with looking at international standards and implementing them. We've seen it on the debt side, where they had to really grapple with this concept of debt forgiveness and debt treatments and all that. So I don't want to kind of judge. Brett has an interesting story to tell. I also have a lot of respect for the IMF statisticians and the statistical department who go through things with a very fine comb and are real experts at what they're doing, so it should be an interesting discussion.
Good, well that tees up your discussion tomorrow with Brad, very well. Nicole, I promised you we would talk about AI, and I don't want to end the conversation without getting there. They say if themes of the week, debt, China's economy, trade frictions, and AI, certainly, probably, are top 4 right now that people are talking about here.
Absolutely, and it was interesting, AI did not factor as strongly in the WEO as it did make a more robust appearance in the GFSR, which I know Martin has gone through in deeper detail than I've had the chance to yet. It actually got its own chapter. But it has been interesting to sort of, again, a little bit of a potential miss in the WEO and in the impact of AI, but just when we think about on the job side, and I've been in both conversations, and it was really interesting to be between the managing director's town hall yesterday with civil society and Ajay Banga's this morning.
Different vibes?
Different vibes, and I'll have more to say on that. Stay tuned. But again, AI kind of coming in as both the threat and the opportunity, right? And how it can, again, be leaned into for the potential increase in productivity, which we know is a big issue in terms of the slower growth. Again, I'm looking into the medium term, but also, can it be cheers or fears in terms of what it means for jobs, which ultimately we know, and labor markets, which is a critical piece, again, not only, but especially in the younger countries where, is Ajay Banga's one of his favorite statistics is 1.2 billion people entering the labor market in the next 10 to 15 years with a projected 420 million jobs, right? So that's not enough.
Yeah.
And if you're, so it's thinking about how you have complementary AI and how you can think about maximizing and optimizing the AI market, which is in and of itself quite sizable, while also leveraging it for, we've been talking about global majority and fintech and financial inclusion and some of the other kind of reaping those positive benefits of AI. But I know Hung and Martin have thoughts on it as well.
On AI, and then Hung, I just want to turn to you, we're almost out of time, but on the US economy, I just want to underscore what is underlying the really positive numbers in the US economy right here.
Right, yeah, US economy, two things. One is the delay impact of previous fiscal stimulation, which is huge, biggest in the world. So we still benefit to some extent. Next year, no more. So that is one. Number two, immigration. It turns out that the surge in immigration has really give US and many European countries a lift up, because without that, growth would have been slower. And it's a pity that we all did not go into that in detail to point out the costs and the benefits of immigrants really in this environment of xenophobia and anti-immigration sentiment. On AI, I'm disappointed after listening to the MD talking about it, because she made a very coherent and good case, because with proper regulation and so on, AI activity can increase productivity, and in her estimate using fund research, lift global growth by 0.8 percentage point every year going forward. And that basically lift the growth trajectory up to pre-COVID level, which is very significant, and I think that is something that that should be focused on.
Yeah.
So in my blurb today for our blog, I say, if the fund can focus the minds of ministers and governors to do two things, AI, and then make the fiscal space for green activity by pulling back the subsidy for fossil fuel, they will have served the membership very well.
Martin, final question to you. We have not talked enough about the euro area. Relatively disappointing picture overall. Germany certainly weighing down, but it's not only Germany that is showing problems in the euro area. We have ECB President Lagarde tomorrow morning at the Atlantic Council. What steps need to be taken to revive growth across the euro area?
Germany is very tight on fiscal, gets a lot of kudos from everybody, but I think they will have to use some of those fiscal means to facilitate the transition that's going on. So far, everybody's been resistant in Germany, but I think the pressures will grow that they will use some of that. Otherwise, any structural reforms in Germany will be very hard. On the other side, in France, you have a debt kind of running pretty high, and you have now some kind of, I don't want to say interim government, but a government that doesn't have a big majority in parliament, if at all, kind of coming up with very drastic measures to rein in deficits. So there's a bit of a tension there within the euro area, but I think it's going to be overshadowed by the sharp, or it has been overshadowed by the sharp downgrade of German growth expectations for next year. Until the fiscal reaction kicks in, it will take some time.
0.8 is 25 projection for Germany.
And in the meantime, they should make progress on the banking union, because that would then provide more financing. But then again, you have the threat of a takeover of a German bank by an Italian bank, and all hell breaks loose, and the banking union seems farther away than ever. Although that's exactly the type of consolidation you would expect and you would hope for, so that projects get financed, and there is the investment levels that Europe needs to compete and grow and do the structural transformation that they have to undergo.
So I always end these sessions with the same question. 6 months from now, when we're at the spring meetings, the April WEO, upgrade to global growth, downgrade to global growth. I believe, I have to check the tape, I think most of you said roughly steady right before the election going in when we did this 6 months ago, so credit to the group. I'm going to go in reverse order of where we started, and Hung, start with you.
Well, depends on what happens 2 weeks from now. We can either upgrade or downgrade the forecast.
Okay, I won't ask you which way is which. People can draw their own conclusions. Nicole.
I am going to go with slowing.
Slowing. Revision downward in
Revision
6
downward.
months.
Not significant.
Yeah.
But I just think, regardless of what happens in 2 weeks, I think some of the downward risks and the pressures, especially some of the MDEs and
Yeah.
yeah.
Martin?
Maybe a bit of an upgrade in the short term, but medium term, more difficulties compared
Okay.
to today.
So up or down, down, up.
Up and
One
up
of
in
you
the
will
short
be
term.
right in
I
6
don't know.
months. So we will come back and assess. Martin, Nicole, Hung, thank you for joining us. Thank you for everything you do on behalf of the Atlantic Council GeoEconomics Center, not just this week, but year-round on our Bretton Woods 2.0 project. And I do want to follow up on something Martin said and give enormous credit to the hardworking staff of the IMF that work day and night to put these projections together. Yes, they are heavily scrutinized. Yes, they are criticized. That's the nature of it. But they are doing their best under difficult circumstances to provide an accurate picture as possible of the global economy, and we all benefit from that. And I wanted to thank them, and we want to thank them for being our host here this week. Stay with us throughout the day at the Atlantic Council. Our next event is at 3:30. We are launching a new report about the economic and social cost of the ongoing war in Gaza. We hope you'll tune in then. We wish everyone a good rest of the day.